let's start then with your view, the debate as to whether or not the Fed ends up pivoting or keeping the bit between its teeth when it comes to inflation, even amid some potentially softer eco data. Does it charge ahead to its 2% target, or does it pivot in the face of weaker data?
I think they're going to have to keep on raising because at the end of the day, the playbook is that they have to have interest rates that are higher than the inflation rate in order to beat inflation. That's the playbook. And with inflation now at 9%, that means they've got a long way to go. So I don't see how they can let up without really going against what they've been thinking for so long. So I think it's going to be a big raise going forward.
Mark, it's great to see you, by the way. The market is not looking for that at the moment. The rhetoric is definitely there, but the price action tells us a different story. Cuts sooner than we think. The Fed can't go as hard as they want because of the slowing economy. When you take a look at asset prices, what asset price has the best chance of re-rating if the Fed still goes hard?
If the Fed goes higher, then the assets that have no debt are the ones that will really be performing. Because as the rates go up, you're going to separate the men from the boys in the sense that those companies that are in debt are going to get in deeper and deeper trouble. And those are the companies that are going to be underperforming. So you've got to keep your eye on those balance sheets and, of course, the Fed hiking, which I think they will continue to do.
Mark, what about the balance sheets of countries and governments around the world in the face of a more aggressive Federal Reserve and a stronger US dollar? What is the vulnerability there?
Mark, can you hear us?
Yes, I
we
think
may have some... Sorry, Mark, go ahead. I think we had a bit of a glitch there, but go ahead.
The US dollar, I think, is going to continue to be strong, simply because globally people are afraid of higher interest rates and declining markets. The pessimism is pretty great out there. And of course, the haven is the US dollar. So the combination of safety, desire for safety, plus higher rates means that the dollar will continue to be strong and maybe even get stronger.
And Mark, we've seen emerging market central banks having to respond by hiking a lot, very significantly large hikes to sort of combat that. How can you be invested in emerging markets right now? What's the case?
Again, well, as I said, we have to go after companies that have no debt or very, very little debt, and companies that still have a business model that will allow them to raise prices. Because in all countries around the world, you have inflationary pressures. So prices are going up on the supply side, and you're going to have to match that if you're a company. And of course, those are the companies that are able to do that are the ones that will survive.
Mark, just turning our attention to China and the role that China historically played, at least 2008, 2009, with that massive stimulus that, of course, had the rewards for the rest of the world in terms of returning the global picture on stronger growth. On the back of that stimulus, can the Chinese do it again, or is the change in sentiment amongst the leadership in Beijing holding them back from that kind of aggressive stimulus?
I think it's going to be very difficult for them to do it. Of course, they're going to try. They've been lowering rates. But the property sector is really the problem in China today. They've got to bail out these property developers that are bankrupt, basically, and the banks that have lent so much money to these property developers. So I can see more problems ahead. And of course, you must remember consumer sentiment is very, very strong when it comes to property in China. Chinese save by buying property, buying apartments. And with apartment prices going down, or at least not going up dramatically, and with all the defaults, then you can have real problems.
Mark, on a fundamental demand basis for China, Bloomberg sat down with Rio Tinto's CEO earlier, and he talked about what he's noticing about China demand from his seat. Here's what he had to say.
And it's always difficult to say how long time will it take that the Chinese economy is being stimulated, and that means that more growth will come in the second half. Is it next month, or is it 3 months or 6 months down the road? It's always difficult to say. I try to predict the very short term. I'm not sure anyone is capable of doing it. But we remain convinced that the Chinese have got the measures and the desire to stimulate their economy.
Mark, I can see you disagreeing with that, and clearly you're going to have Rio Tinto talk in his book, but nonetheless, what are your thoughts?
Well, I think there's no question the government isn't going to be in control of the economy as they have had before, and they're going to simulate it, and they're going to make sure that these companies are bailed out. But it's going to be difficult. It's not going to be easy, and I don't think we can expect the kind of growth rates that we've seen in the past with China. It's a bigger base, of course, so it's more difficult. But also, as I said, the debt levels are so high, it can be a real problem.
So, Mark, what does that mean then for the commodity cycle that we're looking at?
Yeah, I think you're in a situation now where many of these companies will be in a down cycle and will be in real trouble. And of course, as you know, many of these property companies are bust. The game is over for them.
Mark, I get that point for if you look at the demand side of the commodity world, but the supply side does feel like we're in kind of a structural shift rather than a cyclical shift due to the energy transition and due to ESG. Are there any parts of the commodity sector that you think can be better, and the war in Ukraine, by the way, that can withstand a slowdown?
No, I think the commodities sector has already had its run, and you can see most of these commodities have corrected down, including oil. You can see oil's come down, platinum, palladium, gold, etc. So it's already had its run. And of course, this is a reflection of demand. At the end of the day, consumer demand will drive these commodity prices. So we don't expect very much more in terms of these commodity prices. Of course, inflation has played a role, because if you have a devalued currency, it looks like prices are going up. But at the end of the day, it comes down to consumer demand, and we don't think it's going to be there to push prices up very much.
Mark, on the question of gas and gas to Europe in particular, of course, from Russia, we've seen 3 straight days of very solid gains in terms of gas pricing over in the Netherlands. To what extent is the shock around gas priced in to assets, equity markets in particular, here in Europe, as we weigh up the very real possibility, it seems right now, of Vladimir Putin cutting off gas supplies altogether?
It's a real concern. I happen to be here in Amsterdam, and you see a lot of bicycles being used rather than cars. But at the end of the day, people are very concerned about the coming winter and what it will mean for being able to heat homes. Already, they're cutting down on the use of air conditioning and other uses of electricity generally. So yes, it's a big concern.
Mark, before we let you go, I know you mentioned kind of the type of companies that you're looking for with low debt. I just want to get your quick take before we go. What region is that bet most placed in?
I would say right now, in the tech sector, you have a real dichotomy with companies that are in deep trouble with no earnings and high debts. Those will go by the by. They will go down. But then you have some tech companies that are very rich in cash, have a good product cycle, and good earnings momentum. So I think those are the companies that we want to look at.